CPA here in Carson City. I'm here with Toby Tatum.
Yeah.
Once again, we've been doing a series on how to prepare your business to sell, how to make it as profitable as possible to you when you sell your business. And we talked about a lot of issues, but you know, the one we haven't talked about yet is numbers. You know, as a CPA, I love numbers. That's what we like to get into, so it's time, right?
Right.
And so, you know, it comes down to, first of all, you've got to have a good accounting system in place that's been in place for some time, not just now getting put in. Because you've got to have a history of multiple years of being able to demonstrate what your business has done over these years, and the more consistent with some growth, the better. You know, this kind of profitability does not look good to an owner, to a buyer, but this does. Constantly growing, always profitable. So you've got to have a good accounting system in place, and you need to know about some ratios and things that buyers will look at that will tell them your business compared to the industry averages, what makes a good business to buy versus a bad business. And Toby, we're going to talk about balance sheet ratios today. Why don't you go over 2 or 3 of those really key balance sheet ratios that you can start to do now. We can show you how to do these to see how you're doing.
Okay, well let me preface that particular subject with a more of a big picture idea about the financial analysis of the company. First of all, people come, they want to sell their business. The first thing they want to know, well, what is my business worth? Well, as a business appraiser, there's one big step that has to happen before we can even get down and start talking about what is your business worth, and that is, what does the financial performance of your business look like? So the biggest part of a business appraisal, from my perspective, is actually doing the preliminary financial analysis of the company. And to do that, first of all, we have to straighten out the financial statements for the last 5 years. We'll talk about that later. But what I do as part of the financial analysis of the company, there's 4 key areas that I focus on as part of my financial analysis of the company. There is a benchmarking analysis. There is what we call a volatility analysis. In other words, what Kelly was just talking about. How pronounced are the oscillations up and down each year in your cost ratios and your sales ratios and stuff like that. That's called volatility analysis. Then there's trend analysis. How are you trending in sales revenue? How are you trending in profitability? How are you trending in some of your key operating costs? Are they trending up? Are they trending down? Are they stable? And the other part of that then is what I call the break-even analysis. We look at a break-even analysis for your company. So those are all kinds of financial analyses that I have to do first before I can even begin to start talking about what is your business worth. So what we were going to talk about today is, Kelly says, some balance sheet ratios. This is part of the benchmarking part of the analysis. And there are probably over 100 different balance sheet ratios that are possible to produce. But I want to talk about just 3 of them today that are really important to look at for the purpose of valuing a business. The first one I'm going to talk about is what we call your inventory turnover. How many days does it take for your inventory to turn relative to your industry average?
So let me explain that real quick. Let's say you have a $90,000 inventory cost, and you go through that at a rate of about $30,000 a month. That would be 3 months it would take before you turn that inventory. And there's a way to determine that.
That's right. So I'm not going to get into the arithmetic of determining it. The question then is, let's say that your inventory turnover is 3 months. The industry average is 4 months. What does that mean? Is there a strategic reason why your inventory is turning faster than the industry average? Or if you don't have a strategic reason, then why? What it could mean is that you're not carrying enough inventory relative to your sales, and that you're running out of inventory, and that you're possibly losing sales because you're low on inventory relative to industry average. It doesn't prove that, it suggests that. So let's say if the industry average is 2 months and you're 3 months, then that means you have too much inventory relative to the industry average. Again, is there a strategic reason for that? Or if not, and if there's no strategic reason, it means you have too much inventory, and then you're subject to shrinkage, to obsolescence, to destruction, to pilferage, to all those kinds of things because you don't have good inventory control because you have too much inventory. So these are the kind of things we have to look at, we have to get answers for. That's benchmarking of inventory. Now we can talk about benchmarking of accounts receivable. If you have accounts receivable turnover, and let's say that your accounts receivable let me see. Let's say the accounts receivable are, let's say, higher than your industry average. Then that means that maybe that your credit policy is too relaxed relative to the industry average, and that you're subject to a lot of write-offs of uncollectible debts because you have too lenient of a credit policy. And on the other hand, if your accounts receivable are lower than the industry average, that might mean that your credit policy is too tight and that you're losing sales because you have too tight of a credit policy. So, and that doesn't prove any of these. They're just suggestions.
Right.
And the last thing I want to talk about is what we call your fixed asset turnover. And we're talking about particularly your fixed operating equipment, your machinery and your equipment. And that ratio is your sales revenue divided by the value of your fixed operating equipment relative to the industry average. Now, if your equipment, let's say the industry average is a ratio of 2, that your sales revenue is twice your value of the industry average is twice the value of your equipment, and your equipment is turning over 4 times, that means that your equipment is turning over way more often than the industry average. Now that could mean that you're running really efficiency, that you are very efficient in your equipment. Or it could mean that you have old, dilapidated equipment, not enough equipment to get the work done, you're no longer competitive with obsolete equipment relative to your competition, and so forth. Or the other is if your equipment is turning over much slower, let's say that it's a ratio of 1, that means you have way too much equipment on hand. And this is something that I see a lot. Is people have, it's not so much that it requires more equipment to do the job relative to the competitors, it's that you have equipment that you don't need, that's obsolete, that you're no longer using. And that equipment is actually dragging down the value of your business. The more lean you can run with investment in equipment relative to your sales revenue, the more valuable your business will be. So the right thing to do is, if you have excess equipment, is to sell it before you put your business on the market, because that's going to be gravy on top of what you can sell your business for. That excess equipment reduces the value of your business. It does not increase it.
Okay, well there you go. You have a few key ratios with balance sheets. We're going to get into some next time we get together that involve the income statement.
Right.
And we're also going to talk about cash flow, gross margins, and profitability. So there's a lot of things that go into the topic of financial information that a buyer looks at that makes a big difference on what kind of value they're willing to attach to your business and pay you for. So thanks for listening today. We'll get back again next time and talk about those other things.